Well, moving on here to Disney, the company is set to report its fiscal Q2 earnings after the bell on Wednesday. Despite the company's recent layoffs and ongoing battle with Florida Governor Ron DeSantis, the House of Mouse is projected to report strong earnings growth. Let's bring in Jason Bazinet, the Citi Managing Director, to discuss. Jason, as we noted here, this comes on the heels of yet another round of layoffs for Disney, but all eyes are going to be on that direct-to-consumer business. What are you expecting on that number?
Well, just to frame it for you, remember Disney lost about $4 billion in the streaming business last fiscal year. Their first fiscal quarter, they lost about $1 billion in the quarter. And so no real discernible improvement, right? $1 billion in loss times 4 is another $4 billion loss. So what the street will be focused on is hopefully a sharp reduction in the direct-to-consumer losses. The company's pointed to about $200 million of smaller losses, I'll call it 800 million. And I think that's what the street will be focused on. If we end up with a much smaller loss, the shares, I think, will do quite well.
Jason, what do you think we're going to hear when it comes to Hulu? Lots of talk about what exactly that's going to look like here, just in terms of its future with Disney, whether or not it could potentially sell its stake. How do you see Disney addressing Hulu down the road?
Look, I was flabbergasted on the last earnings call, right, which was Mr. Iger's first quarter back, when he said everything was on the table when it came to Hulu. He was uncomfortable with what he called general entertainment, which pointed towards a potential Hulu sale. I think that would be a grave mistake. We would like to see Disney buy in the balance of Hulu it doesn't own, merge that with Disney Plus, rationalize some costs, and really create what I'll call a TV substitute on the streaming world. But I will tell you, I'm in the minority among investors. Every investor I chat with would be thrilled if Disney sold Hulu. So I'm in the minority. But if anything that Mr. Iger does tomorrow or Disney does tomorrow that indicates that they're more open to selling it, the street would applaud that. I think actually it would be a mistake. But again, I'm in the minority.
Jason, the numbers are going to be focused on the first quarter, but have to ask you about what's happening right now and the impact on Disney from the writer's strike. What's your assessment right now in terms of what this means, number one, from a financial perspective, but for Disney's content pipeline?
Well, remember, if you go back over all the writer's strikes, and I think there have been 6 of them in Hollywood over the last 100 years, they typically last plus or minus 100 days. The last one was a little bit over, I believe, 180 days. If you see that sort of delay, I think that's manageable because things tend to slow down a little bit during the summer months for new scripts. But if we end up with something that's more protracted, that goes beyond 150 days, beyond 180 days, it of course will be good for the costs, right, in the near term. And so you could paradoxically see earnings move up, but then it will begin to impact the top line, which would be bad. And so this is, I think, a highly contentious issue in Hollywood right now, because it comes at this strange intersection of sort of two technological things happening at the same time, right? The streaming world has sort of upset the sort of monetary algorithm that writers were accustomed to. It's also reduced the periodicity or predictability of what a writer can expect to generate, because they're moving from show to show to show, unlike the old linear days. And then third, you've got artificial intelligence out there, right, which a lot of investors are focused on that could play a role. And the writers themselves are trying to limit the use of AI in the context of writing scripts. And of course, the management teams want to preserve all that optionality. So you have a lot of moving parts, all of them underpinned by technological change.
Jason, let's switch gears here a little bit and talk about their parks business, because that was very strong last quarter, up 21% on a year-over-year basis. What do you think that number is going to look like on Wednesday? And do you think that momentum is sustainable?
Yeah, everything we've seen out of the live and experiential part of the ecosystem has been incredibly robust. The street's been talking about a recession for a little over a year now. We're just not seeing it in any of the numbers. Maybe there have been some advertising numbers on the B2B side that have been soft, but at the consumer level, it's been quite resilient. And I would say that one of the things that surprised me during the great financial crisis with Disney is, there we were shedding 700,000 jobs a month. The S&P 500 was around 670 points. Everyone's far okay with a disaster. Their home values, many people are underwater on their mortgages. And the parks business didn't do that poorly. So I think a plain vanilla recession, even if we have one, is fine for the parks. For the quarter, I think they're going to have great numbers.
So looking to where we are right now, what do you think is going to be the big driver moving forward? Is it really still going to be about cutting those losses in streaming, or can we expect, a significant bump as we go into the summer season with parks?
Yeah, I think you could see a bump in parks, but for sure, I would say 80% of the narrative on Disney stock is shrinking those DTC losses, because if you looked at the PE multiple that Disney's trading at using historicals, it would look like a very expensive PE multiple. But you take those $4 billion of losses and you drive them towards zero, and you're going to get a lot of earnings growth, right? And then the multiple doesn't look so expensive. So anything that Disney can do to shrink those losses faster is going to be the most important thing for the stock, for sure.
All right, the stock off nearly 8% over the last 3 months. Jason Bazinet, great to have you. Thanks so much for joining.